Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock analysis. With me today is David Blake, CMT, here to discuss what happened in the market last week and what to look out for this week. David, how are you today?
I'm doing well. A little bit chilly, but doing well.
Good. Let's jump right in.
Well, last week we had another pretty volatile week. We started out, came back from the holiday with kind of a sell America movement in the global markets after some of Trump's comments, and stocks just really took a dive globally. I think the Dow was down almost 900 points. The S&P 500 and NASDAQ actually had erased their year-to-date gains on that Monday. And then we also saw a flight to safety, as we've been seeing here for several months now. As all this turmoil is going on, we had precious metals were higher. Gold and silver made new highs. That's continuing today, by the way. We had gold cross above 5,000 an ounce, and silver actually SLV is up above $100, which is pretty amazing when you think that silver has actually tripled over the last year. That's something you will never see probably again. If you're in it, I think you just hold on for a little bit and ride this parabolic move until it starts to pull back. Well, anyway, after that big fallout, we did see Trump back down and came out with an announcement that a framework of a deal with Europe and Greenland was on the table, and that gave everybody, they all jumped back into the market. We also had the Monetary Bank came out and upgraded global growth, said that the global economy recovery still should keep the markets trending higher in 2026. We actually pretty much had erased all the Tuesday losses by going into the market on Friday. We ended up trading a little bit mixed ahead of the weekend. Part of that was we had an uptick in rates as we continue to get better than expected economic data. Third quarter GDP increased to 4.4% from 3.8 in the second quarter. The jobs report remains steady. We still have only about 200,000 initial jobless claims a week. We had a big drop in continuing claims, so that's good. But one thing that we talk about often in these things, and even in the weekly market letter, is how you kind of want to keep an eye on the secondary indexes, which I could consider the small cap Russell 2000, the Philadelphia Semiconductor Index, and also the Dow Jones Transportation Index to be indexes that you'd like to see leading the broader market higher and lower. As a market technician, we like to see that. The reason being is if those are leading the market, that means that investors are probably putting a little bit more money into more speculative investments. They're not investing in the Procter & Gamble and the IBM and the Walmart, that type of thing. They're branching out a little bit and looking at the smaller caps and maybe some of the transportation indexes. And of course, with transportation index, the Dow theory goes into effect when the transports and the Dow Jones are both making new highs. That's a Dow theory buy signal. And we've had that for quite a while now here, for at least for the last month. So it's good news that we're seeing those lead the market in here. You want to keep an eye on that. As long as they are continuing to outperform the Dow and S&P 500, that means that our market is probably going higher. I think the sectors last week were mixed. We had a big jump in the energy sector with crude oil prices moving higher. They were back up above 60. I think they ended up around 58, 59, that area a little bit. But the energy sector was up about 3.5%. We also had strength in materials, which I really like. That's breaking out to new highs. Communication services got a big boost from Meta, having big gains. Healthcare was strong. And then your financial REITs and utilities were the weakest sector. They were down about 2%. Interesting with financials right now that they're not starting to be a little bit stronger with strong economic data. That's something you want to, it's a little bit worrisome. In fact, when we had the big money center banks come out with earnings, initially they kind of nudged up a little bit, and now they're all below where they were before their earnings came out. So that's a little bit troubling, but not a reason to sell the market. Again, we're still seeing some of the Mag 7 companies, they had pulled back quite a bit, and they'll probably be pretty volatile this week. In fact, we have, I think, 4 of the Mag 7 companies are going to release this week. On Wednesday, I know we have Microsoft, Tesla, and Meta, and then I think Apple reports on Thursday. So that's something that will probably add to the volatility of this market. As far as the technical condition of the market goes, It's still strong. That Tuesday when the market sold off, we did see the S&P 500 and NASDAQ slip below their 50-day moving average. But then, actually, the NASDAQ went all the way down to this 100-day moving average. But they were able to bounce off those levels of support and actually closed above them as the week ended. So that kind of shook out some of the weak hands, and we got back with some stronger hands in here, which should be good for the market this week going forward. Momentum is positive, but it has slowed quite a bit. The 14-day RSI is going sideways. I did make one note in the market letter, and that is, let me actually go to a chart on this. This is the ETF for the S&P 500. Okay, as you're seeing these big pullbacks coming in here, a woman named Connie Brown, actually here from Atlanta, and one of her books is called Technical Analysis for the Trading Professional. She noted that not only is the 14-day RSI good for discovering overbought and oversold periods in the market, but it's also in a bull market, when you have these pullbacks, as long as the 14-day RSI indicator stays above 40, it could dip down to 38 or something. As long as it stays above 40 and then begins to move back up, the ongoing trend, bullish trend, is still intact. Now, on the other side, when the market's kind of going down, you get these intraday rallies. She's noted that these little spikes on a downtrend are probably going to top out with the 14-day RSI around 60. So if you notice on here on Tuesday, I guess it was, we got down exactly to 40, as you can see here on this in this chart right here, which means that we sold off down to about where we should to keep the trend alive, and now we should start to move up a little bit higher. So that's something that you can follow that's kind of off the charts for most people. They're not aware of that unless they're a real market technician, but it's something that I observed that I thought was worth talking about a little. We also saw the VIX over the last couple of days. We had jumped up, I think, on Tuesday up to around 21. And then we ended up pulling back all the way down to the 15s. And then I think we ended up at 1609 on Friday. That means that the active traders aren't real concerned about a market rolling over here, that we're going to see a 5-10% pullback anytime over the near term. So that's something to also consider. We did note it last week, or a week and a half ago. So we did see our MarketEdge S&P short range oscillator that Jim Cramer talks about all the time. It had gotten up to 6.39%, which often is kind of a signal that you're going to see some profit taking. And actually, with the market being overbought on the previous week, when Tuesday's selling hit, it just added to the downside. When you're overbought and you get some news that shakes things up, it's going to induce a little bit more selling in the market than what you might see. And that's exactly what we got. They kind of overdid it, but it did work off the overbought condition. And now I think, as you saw on that 14-day RSI, we're back up to around 60 or something like that. And then also on our S&P oscillators, you can see up here that we bring out here, it was at 2.91. So this needs to get up above 4 before you even start talking about an overbought market. And then when it gets up around 7, that's when you'll start seeing some action from big traders and institutional players. So everything looks fine on that. That indicates that we probably have some more upside to go. So that's all good for the market going forward here in the next couple of weeks. I did want to say that under market breadth last week was positive. It wasn't great. Your advanced decline line actually was almost even for the NYSE and the NASDAQ. But before the NYSE actually is posting new highs, and it's in the advanced decline line. And that is just a signal that you should notice. That means that the rally is broadening out. It means more stocks are going up and then going down, which means they're under accumulation. And then also with the new highs and new lows, the NASDAQ on Thursday had 570 new highs. And that's coming off of just having like 2 or 3 weeks ago, 50 or 80 new highs. So they're really expanding that out, as you can see, especially in the small cap, Russell 2000, all these stocks making new highs. That 570 new highs was actually the most in a single session for the NASDAQ since November of 2024. So that's a confirmation that you're seeing the broadening out of this rally. I did want to mention one other thing on sentiment. A couple firms came out talking about the retail investor moving into the market. Goldman Sachs saw strong inflows into the U.S. and emerging market equity funds, totaling $71 billion last week. And it was actually led by retail investors. So One of the reasons for that, I think, is you're seeing a lot of this noise that's going on in the market. You're seeing people pull out of the US markets, and that's opening the door for more money to go into emerging markets. JP Morgan, a week before that, talked about the retail investor had poured $12 billion into equities. This was like, I guess, 2 weeks ago. And that was buying single stocks at the highest level in 9 months. So again, as the market's going higher here, you are seeing, especially the retail investor chasing the rally. That's good in the short term until things top out and we roll over. We just want to make sure that it's not too bullish. We're bumping up against that being too overly bullish, but it's not quite there at this point. We still see the institutional hedge fund guys are still around 88% invested. That's almost fully invested. That's been as high as 100% several weeks ago, but they're not pulling money out at this time either. So things look good. We do have more room to the upside. We have a busy week coming up this week. Tomorrow, we start the January FOMC meeting with the conclusion of that on Wednesday at 2 o'clock. They'll make the announcement on rates. I think right now there's a 98% probability that they do nothing, which I'm sure that's what they're going to announce. People will listen a little bit to Chairman Powell's press conference at 2:30 just to see how divided the committee is on the future outlook for rates. Of course, we have the doves and the hawks, but I think you're going to see, especially with this stronger than expected economic data that we've been getting recently, I think the CME group, FedWatch, isn't projecting a rate cut now until maybe June. So it's not going to be that much of a swing in the market. Some of these things, when it's kind of a coin toss where they're going to raise or cut, you'll see a little bit more volatility going up into that. Now, I did say that Wednesday we're going to see out of Microsoft and Tesla announce earnings. Tomorrow we have a lot going on too. We have UPS, United Health Group, Boeing. So several of the Dow components will be reporting tomorrow. And I did want to mention one thing going forward here for this week. There's an awful lot of noise in the background. If you're an investor and you're watching the news, a lot of the geopolitical tensions that you hear about, especially involving tariffs and that kind of thing, it's just a lot of noise in the background. And I think you'd be better off if you don't make any rash investment decisions on that. One of the things about technical analysis is that it looks at the swings and highs and lows, resistance and support areas in stocks and in different indexes. And a lot of times with this noise, what will happen is you'll see something pull back to a support zone and then start to move back up. If anything, you might use the noise if there's something that you like, as long as the fundamental and economic data in the market is solid. When you get some of this noise, it pulls back to some support areas, which you can find on any stock or index in MarketEdge. You might use that to add to a position that you really like. When you pull up a second opinion, let's do UPS instead of coming out tomorrow. Okay, we have a long waited on this, but when you go to your second opinion, here's the 50-day moving average over here. We'll give you some parameters. Here's a sell stop. It gets below that, might be in trouble. If you see the stock pull down here around 106 or something like that, it might be a nice time to add on to it. The relative strength, and I always tell you want to buy a stock that's 0.98 or higher, that it's matching the S&P 500 or outperforming, which I prefer. Looks good. You have the stochastics are overbought on the fast one, the slow one is not overbought. So you have a lot of things on here that look good. The stock's not overbought. So if you're looking for pullbacks or anything like that on earnings, this would give you a chance to see where those levels might be that you can maybe add to a position. Or if they have bad news, you may want to take it out if it breaks some support. Another thing I did want to mention, this earnings season, we've had quite a run here in November and in December and in the first part of January. You're not seeing companies that beat jump up $5, $6, $7, $8 a share, which you sometimes see, but you are seeing a lot of companies if they're a little bit light or they have a little bit the softer guidance, like Intel on Friday was down 17%, it's down another 5% today. They are taking them out behind the woodshed if you disappoint. So don't be thinking that these earnings come out and they are solid and they're going to stock just kind of sits there. Watch it for a couple of days, see if it does pull back. A lot of these companies that are beating estimates, it's kind of already been built into the stock. You don't want to get a report come out, it looks good, you jump in to buy the stock because they're not holding their gains after earnings like they do in some quarters. So I don't see any reason to be chasing stuff in here. Just keep an eye on the companies you like, and maybe if everything else looks good, the big picture looks solid. But if you get a pullback to some of these support areas, you might add to position rather than chasing something new. And that's about it for this week. I still think the major trend is still higher. And with the Mag 7 coming in here, we may have a little bit more volatility this week. But block out the background noise and just concentrate on what companies that you own or want to buy, how the earnings reports are coming out and how they're holding up after they come out with their earnings.
Very good. Thank you, David. Is there anything else before we head into the rest of the week we should check out or know about?
I don't think so. Again, you have the FOMC meeting is going to be big, and then some of the big Mag 7 stocks, and that can cause some intraday volatility. But the FOMC isn't going to say anything that's going to surprise the market. Well, you hope not. And then again, we just look for the guidance on some of these Mag 7 stocks. And so I certainly wouldn't be jumping in to buy gold or silver in here. But if you have it, a parabolic move, when they go up like that, when they turn around quickly. So if you have a double in some of those, maybe you peel back a little bit and let the free money ride on those things. But at some point, you're going to see you're going to see, this is quite a move here from December, $50. You've had almost a double in silver just since December. You don't normally see that. So at some point, when you see a parabolic move like this, you'll come in here one day and it'll be down 8, 9, 10%. So that's something to be aware of. And you want to sell into strength rather than to sell into weakness. Just remember that's what most successful traders will do.
Very good. All right. That's it for today, everyone. If you would like to take a look at MarketEdge.com and learn more about our technical analysis available on over 5,000 stocks and ETFs, give us a shot at MarketEdge.com. Your first 2 weeks are free. If you have any questions for David or anyone else on the MarketEdge team, please feel free to reach out at support@marketedge.com or drop a comment if you're watching on YouTube. Thanks so much, and we'll catch you next week.
Sounds good.
All right. Thanks, David.